Why are Huawei phones not selling now? Previously, when the foldable phone was priced over 7,000 yuan, it was in high demand. Take a look at this phone, the sleek and attractive Nova Pro, which has now dropped to over 4,000 yuan and features a Kirin chip. Why is it not selling? This is an observation from the owner of a Huawei flagship store. Since April of this year, smartphone sales have plummeted drastically, and even Huawei phones, which were previously marketed with a patriotic appeal, are now struggling to sell. The situation looks bad. Earlier this year, before April, we couldn't even get phones priced over 7,000 yuan. Now, even at 5,500 yuan, they're not selling. I'm really confused about what went wrong. It's clear now why people prefer Apple phones. Huawei phones lose value fast. I finally understand what it means to buy high and sell low. Phone prices go up with demand, but when prices drop, no one wants them, kind of like what's happening in real estate. Basically, if you have Huawei phones that are losing value, sell them quickly. On July 14, the second-hand phone dealer and blogger, Free Mind Tech Yuan, mentioned that Huawei's situation has deteriorated significantly recently, with the Mate 60 Pro's market price plummeting severely. He recently reported on social media that Huawei is facing significant market challenges, particularly with the Huawei Mate 60 Pro. The value of this model has dropped by 1,000 to 2,000 yuan in just over a month. Once highly sought after at the end of last year, with prices even exceeding market value, the current situation paints a starkly different picture. Now it seems there's little demand, with recycling prices falling from around 6,000 yuan to just over 4,000 yuan. This downward trend is consistent across all Huawei brands, with prices depreciating rapidly over the past couple of months. Another tech blogger highlighted that the price of the Huawei Pura 70 Ultra is also on a steep decline. Originally priced at 9,999 yuan, a figure that many found excessive, it has since dropped considerably. The speed and magnitude of Huawei's price reductions have outpaced those of other top-tier flagship phones. In fact, Huawei's situation is not an isolated case. Recent data reveals that the domestic smartphone market has plunged by 32.9%. Whether it's high-end brands like Apple and Samsung or budget-friendly options like Xiaomi, phones across the board are struggling to sell in China. Currently, fewer Chinese consumers are willing to spend on smartphones due to tightening budgets. This reluctance to spend has led to unsold Huawei Mate 60 and Apple iPhone 15 models, forcing them to cut prices. This phenomenon was unprecedented in the past. During pre-sale of Apple iPhone 14, consumers eagerly awaited and often had to wait months for a popular model. However, with the release of the Huawei Mate 60 and Apple iPhone 15, even though consumers are interested, they are not willing to pay, contributing to a cold spell in the smartphone industry in 2024. The ongoing downturn in the smartphone market has now extended to South Korea's Samsung, a major player in the Chinese market. In 2013, Samsung was the largest Android smartphone supplier in China, with its market share peaking at 20%. However, since 2018, the company's sales in China have been on a decline due to the country's economic downturn and weak domestic demand. Although recent reports indicate that Samsung still holds the top spot in China's smartphone market with a 19% share, this is a significant drop compared to its peak performance. In recent years, Samsung has closed several production facilities in China, including smartphone and computer factories, relocating operations to countries like India and Vietnam. This shift resulted in significant layoffs, affecting China's economy. Despite these changes, Samsung has not completely exited the Chinese market and continues to operate some business activities. However, in late August, Samsung announced further plans for layoffs and business adjustments, signaling ongoing challenges for the company in China. Samsung is starting to lay off employees again, which isn't a positive sign. At its peak, Samsung had over 60,000 employees in China, but now that number is down to fewer than 20,000. If their smartphone business is struggling, it's noteworthy that Samsung still leads globally in smartphone shipments this year. So why the layoffs in China? Is it due to the sluggish market? Is Samsung considering exiting the Chinese market? According to a September 4th report by the Seoul Economic Daily, Samsung Electronics plans to cut 8% of its Chinese sales department staff, about 130 people. The layoffs are attributed to intensified competition and economic downturn, which have weakened domestic demand and made the company's future in China more uncertain. The company is implementing extreme restructuring measures to ensure survival. However, some online commentators suggest there might be other reasons behind these layoffs. One commentator mentioned, analyzing the reasons for Samsung's layoffs reveals a deeper warning. Firstly, it's argued that Samsung's survival is challenged by fierce competition from Chinese domestic brands, leading to poor sales. The data shows that Samsung's overall industry sales are on an upward trend. As a conglomerate, Samsung is not solely dependent on its mobile business, so despite the impact on its smartphone division, it won't face severe issues. Samsung's sales in China have consistently ranked among the top, making it an exaggeration to claim they are outperformed by domestic brands. Another aspect is China's environment. Samsung is annually recognized as the most socially responsible foreign enterprise in China, yet this is rarely reported in the media. This lack of coverage reflects a broader trend in Chinese media, which often avoids positive stories about foreign companies, including Tesla and BMW. Despite building numerous factories, creating jobs, and contributing taxes, foreign companies often receive little credit. With China's economic downturn, it's expected that the trend of foreign companies gradually leaving China will become more frequent. Currently, industry sources suggest that Samsung Electronics China has issued restructuring notices to sales department employees and is accepting voluntary resignation applications, essentially signaling that layoffs are imminent. An insider from Samsung revealed to the media that this round of layoffs is just the beginning, with an anticipated reduction of up to 30% by next year. The primary reason remains the poor sales of Samsung products in China, such as smart TVs and phones. Samsung China responded that the layoffs are part of necessary business adjustments and personnel optimization to improve organizational efficiency and market competitiveness. The company confirmed the speculation that it plans to reduce its sales department staff in China by 30% by 2025. For many Samsung employees, this news is shocking, but given the current economic conditions in China, it was somewhat anticipated. According to data released by the National Bureau of Statistics on September 9th, China's Consumer Price Index, CPI, in August grew by 0.6% year-on-year, slightly below the 0.7% forecast by Reuters analysts. The increase was primarily driven by adverse weather, pushing up food prices, which forced consumers to spend more on essentials rather than on revival in domestic demand. Excluding volatile food and energy costs, the core consumer price index rose by only 0.3%, the lowest level since March 2021, indicating that overall demand in the Chinese market remains weak. In fact, recent sales data of mooncakes in the Chinese market reveals a concerning trend. Traditionally, during the festive season in China, consumers would buy mooncakes in large quantities, driven by the festive atmosphere. However, the mooncake market has recently shown an unusual pattern. A business owner who sells Mid-Autumn Festival gift boxes said,
"This year has been the toughest in the past 5 years. I'm not sure if other business owners feel the same. Let's look at it from the customer's perspective. For instance, people who bought mooncakes last year or in previous years may not need them this year, or they've cut back on spending. Larger clients tend to show this shift more than smaller clients. Corporate customers like hospitals, training institutions, 4S shops, insurance companies and real estate firms typically buy mooncakes. But this year, some aren't planning to give mid-autumn gifts at all, while others are still giving mooncakes but deducting the cost from employees' paychecks. So a 100 yuan gift box from last year is now being replaced with one worth just 35 to 40 yuan.
Similarly, the white wine market is also facing a sharp decline. Luzhou Laojiao, a renowned Chinese liquor brand known for its Guojiao 1537 liquor, hailed as a living cultural relic and a standard-grade Chinese liquor. However, it too is experiencing significant sales issues. This year, the company became the worst performer among white wine producers. According to reports from September 8th, Luzhou Laojiao's stock price has dropped over 36%, far surpassing the declines of other liquor companies such as Motai, Wu Liangyi, and Fenzhou. On September 5th, its stock price hit a new low for the year, with its market value plummeting from over 450 billion yuan 3 years ago to around 160 billion yuan now. The primary reason for this drastic drop is a significant slowdown in performance. It's not just Luzhou Laojiao, the entire Chinese white wine sector is in decline. Motai, China's leading white liquor brand, is also seeing a price drop. As of September 5th, the wholesale price of a bottle of Feitian Motai is 2,610 yuan, down 10 yuan from the previous day. Typically, the approach of the Mid-Autumn Festival boosts traditional white liquor sales. However, this year, the market for top-tier liquors, including various Motai products, has not experienced the usual price hikes or demand surges. Instead, prices have been fluctuating recently, with no significant rebound in market demand. One distributor commented that this year's mid-autumn market is experiencing the coldest liquor prices in the past decade. Several industry analysts believe that the main issue for the white wine sector is insufficient purchasing power. As the supply of premium liquors increases, their scarcity decreases, and if demand growth lags, price pressures will continue to rise. The real market consumption has dropped even more sharply than production. According to Financial News, in 2023, the white wine production capacity was 6.3 million tons, only 46% of that in 2016. From 2019 to 2023, China's white wine production capacity decreased by about 20%. Meanwhile, the total inventory of 20 listed white wine companies on the A-share market reached 133 billion yuan and 149 billion yuan in 2022 and 2023, respectively, compared to just 91 billion yuan in 2019. A Chinese commentator noted that this situation is quite normal, as these high-end liquor brands aren't typically consumed by the average person. When ordinary people buy this liquor, it's more for the status symbol than for drinking. Despite heavy promotion, sales are bound to decline because any bottle priced under 500 yuan is bound to give you a headache. Most regular consumers prefer cheaper bulk liquor, which they believe is better than these expensive brands. Given this, the commentator questioned how these brands could expect their sales to increase. Michelle Lam, a Greater China economist at Societe Generale, believes that deflationary pressures on China are becoming more entrenched, which could lead to a spiral of falling prices and wages. She warns that more aggressive policy measures are needed to address the situation. Despite attempts by the Chinese authorities to obscure the full extent of the economic downturn, official data still paints a bleak picture. With prolonged weakness in the real estate market, high unemployment, mounting local debt, and escalating trade tensions, China's economy has struggled to gain momentum in the second half of the year. The sharp decline across various industries has attracted significant international attention. In August, China's core inflation rate increased by just 0.3%, marking the 18th consecutive month that inflation has stayed below 1%. Bloomberg noted the surprising speed at which China's price outlook is deteriorating. Bloomberg forecasts that due to weak wages and demand, the price decline in China is expected to continue into 2025. Analysts at BNP Paribas echo this sentiment, predicting that China's GDP deflator, an important measure of economic price changes, will continue its downward trend into 2025. This could mark the longest period of deflation since China began recording data in 1993. The GDP deflator is a broader economic price measure, and using this data provides a clearer picture of China's economic situation. The persistent downturn in China's real estate sector, now in its third year, has stifled domestic demand, while intense competition in manufacturing has driven prices down even further. Despite efforts by Chinese officials to suppress discussions about deflation and warnings to analysts to avoid using such data, the issue has entered public discourse. Former Chinese central bank governor Yi Gang acknowledged the growing threat of deflation on September 6, stating that eradicating it should be a top priority for policymakers. This rare admission highlights the seriousness of falling prices on China's economic outlook, and Yi stressed the need for urgent action to alleviate deflationary pressures. Similarly, Morgan Stanley's chief China economist Robin Xing highlighted the severity of China's economic deflation, stating, "We are definitely in deflation and probably going through the second stage of deflation. Experience from Japan suggests that the longer deflation drags on, the more stimulus China will eventually need to break the debt deflation challenge." China now faces the risk that deflation could snowball. With wages declining, households are cutting back on spending and delaying purchases in anticipation for further price drops. This reduces business revenue, dampens investment, and leads to more layoffs, eventually causing bankruptcies among both families and companies. Surveys show that this situation is already unfolding. According to an August survey by Caixin Insight Group and Business Big Data, primary wages in favored economic sectors, such as electric vehicle manufacturing and renewable energy, have fallen by nearly 10% from their peak in 2022. A survey by the Chun Kong Graduate School of Business also found that labor cost growth last month was the weakest since April 2020. Deflation expectations are spreading in the market, leading to a rebound in bonds, which has pushed yields to record lows and highlighted concerns over banks being overly exposed to interest rate risks. To stimulate the market, the People's Bank of China has lowered the required reserve ratio multiple times and has proposed further reductions. Its Monetary Policy Department Director, Zhou Lan, believes that the effects of earlier reductions are still showing, with the average deposit reserve ratio at about 7%, indicating further room for cuts. However, American economist Davey Wong disagrees. He believes that with a reserve ratio already at 7% and historically low at 8% or above, future reductions will be limited. Wong argues that this measure will not resolve China's current economic problems and considers the official stance as merely a placebo. As China's economy continues to decline and numerous businesses go bankrupt, the decreasing value of real estate, often used as primary collateral, has resulted in surge of bad loans and non-performing assets. With deposit reserve ratios reaching low levels, many banks are now at risk not only of bankruptcy but also of being unable to redeem deposits, highlighting systemic risks. Consequently, the central bank's actions are viewed more as psychological reassurance than as meaningful solutions to the underlying economic problems. Critics argue that the Chinese Communist Party's stimulus measures have failed to address the root cause of the economic downturn. The government's focus on investment has increased fiscal burdens and worsened overcapacity. Meanwhile, the CCP has avoided confronting the deeper issues, such as authoritarian politics stifling market growth, widespread corruption, and the loss of public confidence in the government. Observers believe that the party's reluctance to use its wealth to support the economy and its disregard for long-term economic health are key reasons why China's economic outlook continues to worsen.